Hello and welcome to LawHelp Australia, where we keep you informed and safe with tips and updates. In today's program, we are going to talk about small businesses and tax implications. We are privileged to have an expert in the area and members from the community. Let me first introduce Dr. Keith Kendall. Welcome to the program, Keith.
Thank you, Dinesh.
And Keith is also a barrister at law from Owen Dixon Chambers, and he's a senior lecturer at La Trobe University. Keith, tell us a bit more about yourself.
Well, I've been practicing in taxation, Dinesh, for nearly 14 years now. The last 3 years being at the Victorian Bar with my own practice, and the last 10 years I've been teaching at La Trobe Uni, mainly in taxation law, but other areas as well.
And we have with us Simon Heaney. And Simon, tell us a bit about yourself. He is also a small business owner.
Thank you, Dinesh. Yep, I've been interested in business since I can remember. I think I had my first little business when I was 16.
Right.
And throughout university, I studied law at La Trobe, lucky enough to be lectured by Keith at one point. Set up a small cleaning company, and my interest in business has always sort of been there. Right. As a result, when I finished university, I've ended up practicing in commercial law, predominantly in commercial litigation. And 12 months ago, I took the plunge and bought a bar in Fitzroy. Right. I'm now learning the ins and outs of the hospitality industry.
All right, interesting. And we've got Dishani Yatavara. Dishani is an entrepreneur. And Dishani, tell us about yourself.
Right. I came to Australia in 2008, so I've been here nearly 7 years. I'm a marketer by profession, digital marketing predominantly. I have my own little business, but I also work for the State Trustee Department, so a government official. So I would love to get to know about how to, setting up small businesses, because I have my business running as well.
Right. So you would have some practical questions to ask Keith as well.
Definitely.
All right. We'll get into the topic. Keith, when someone is thinking about getting into business, where do you start? Whether it may be a small business or on your own, where do you start?
Well, the very first question, Dinesh, that you need to consider is whether you're actually creating a business, starting a business completely from scratch, or whether you're going to be buying an existing business. If you're buying an existing business, there are a number of other factors to take into consideration over and above when you're starting a business from scratch. The first thing that I would recommend if you're buying an existing business is to buy the business itself rather than the entity that business might be operated through. So the business might be operated through a company, for instance. So rather than buying the shares in the company, it's better to buy the business from the company. The reason for that is if you buy the company, one of the main reasons, if you buy a company, any liabilities that company has, so loan agreements, employment agreements, lease arrangements, that sort of thing, they come with the company as well, and you might find yourself liable for debts that weren't disclosed.
Those obligations come to the new owner.
That's right.
Whereas you cannot terminate them if you are also interested in buying the business structure as well?
There may be opportunities to terminate those obligations, but it's a problem that you would probably rather avoid.
Sure.
is the concern. Now, from a tax perspective though, when you're purchasing a business, there's the opportunity to purchase the business without having to pay GST.
That'll be interesting. How do you do that?
It's called purchasing the business as a going concern. Now, to use the technical language, a supply of a going concern is GST free.
Keith, can I ask again, what's a going concern?
Going concern is the term that's used essentially for a continuing business, a business that is operating at the moment and is expected to continue going on in the future.
Right.
So a purchase of a going concern is GST free, which essentially has cash flow advantages, because you would essentially get that GST back later on in the form of what we call an input tax credit. However, there will be a delay. In effect, you have to pay an extra 10% up front. If it wasn't GST free, you would need to pay an extra 10% up front, and then you get that back, but perhaps some months later after you lodge a business activity statement. So there's a cash flow advantage with purchasing a business as a going concern and having it GST free.